good morning, everybody. Today we're going to be talking about the principles behind financial modeling. Now, my background is very much in real estate data, and I get very interested in how that data is actually used in decision making. So that could be in portfolio construction, but it can also be in the asset appraisal process. So we do a lot on the course on what sort of data you should use in your models. When it comes to the principles of models, what we're really trying to think about is what sort of metric we're going to use, where's risk being taken account of in our analysis. So that's what we're going to talk about. So it's real estate financial modeling, and what we're basically talking about there is you're doing an analysis of a property. Now, this could be as a direct equity investor, so you could be the equity owner, or you could, of course, be lending on that property. So you could actually be investing in the debt. The principles are basically the same. So what we need to make sure that we've set up in our model is that we've set the analysis up correctly in order to make a decision, and the decision is whether or not we should invest, and that decision should be based on what's the potential return that we could get from the investment and what are the risks from that investment. So they're the sort of core concepts. Now, the time value of money underpins basically this whole analysis, and it's a very, very simple idea, but it's absolutely crucial. So you might be thinking, well, I understand the time value of money, but we'll keep referring back to the time value of money. What the concept of the time value of money is basically that money in the future is worth less than money today. So Einstein summed it up quite nicely by saying that compound interest is the eighth wonder of the world. He who understands it earns it. He that doesn't pays it. So it is a very important concept underpinning our analysis. Now, what I want you to think about in terms of this is we're quite used to the idea of compounding up. So quite simply, if you put some money in the bank, so you put £100 in the bank and you've got an interest rate. It used to be that you didn't get an interest rate when you put money in the bank, but these days I think you are starting to get at least something. Let's say you get a massive 5% per annum, then next year you'd have £105. After that, you'd have a little bit over 110, etc. So that money would be compounding up. So you'd earn interest, not just on the principal, but also that interest as well. So what we want to do is we want to do that in reverse. So when we're doing our analysis, we want to take the future cash flows that we're getting from that property, and we want to discount it back to today's value. So whenever you've got a metric, what you should be thinking about is that metric actually giving me this compounding factor? So when we choose between our metrics, we want to make sure that metric is giving us a genuine compounding factor. So if it was basically substituted for the interest rate at the bank, would that actually be the amount of money that you would get, or is it in some way distorted? It's also important to recognize that how certain that return is also important. Now, what we tend to find is people talk about risk an awful lot, but they talk about uncertainty not enough. So what you should really be thinking about is certainty. Risk is a very it's not quite always the most useful word to use. So think about certainty and think about uncertainty. So a certain return is worth more than an uncertain return. And we need to know what risk return trade-off is acceptable to the client. And we also need to know what's the sort of context of this investment. So what on earth do I mean by that? So when we're doing our analysis, we need to have an appreciation of who we're doing the analysis for. Who is the ultimate client? So it could well be that you're working, say, in a property company, and therefore the return is going to go to the shareholders. So the return that's acceptable to the client is basically determined exogenously. It's decided outside of your analysis. Now, in the terms of a property company, that is what we call the weighted average cost of capital. We're not going to go through that today, but hopefully you've heard of something called the weighted average cost of capital. And that's basically determining what return you should be getting from your investment. The example we're going to use today is if you're working for an unlisted fund. And that could be closed-ended, it could be open-ended. So what I mean by an unlisted fund is we have a fund that's been created and we've got investors in that fund. So we're co-investing. And that fund has been marketed to investors. Now, the terminology that tends to be used is things like opportunistic, value add, core plus, and core. Now, the purpose of today is to not to talk through what those different, they call them styles, are, because we could have a good discussion about what do these, how these styles are come up with. What we're interested in is this number here. So this number here is the return targets for each of these different styles. Now, they're just ranges here because you can obviously get, it depends what country you're investing in, what sector. But basically, this is telling you what the client is expecting as a return. So the fund has been marketed as a particular style, and that style has got a particular target rate. And that target rate, therefore, has become your discount rate. That is your cost of capital. So that's determined externally. So this is where your discount rate is going to come from. So if it's a listed company you're working for, it will come from the listed markets, from the exchanges. That's called the weighted average cost of capital. It's an unlisted fund. It's come from basically how that fund has been marketed. If you're working for an internal client, then that internal client itself will have its own required return from your portfolio. So you need to appreciate who is going to be the ultimate owner of this property. What's the portfolio context? Because if you're a lender, for example, then you're actually probably only going to be lending on one asset. But if you're an equity owner, you're probably going to be putting it into a portfolio. So you need to understand what the portfolio context is and what the required return on that portfolio is, because that's going to determine your hurdle rate. So how are you actually going to make the decision? So we've got two key decision metrics. One is the net present value, or the NPV, and the other is the IRR, so the internal rate of return. Now, the textbooks will tell you to use the net present value, and in the property industry, we tend to use the IRR. There are other metrics available. So there are metrics such as the equity multiple, the cash on cash, and also the simple profit. So let's have a little think about these metrics and what are the sort of attributes of each one. So here's our net present value. So what is the net present value? So what we're doing is we're basically doing the present value of all of the expected cash flows from the investment. And then we're going to do some discounting of those cash flows. So that's absolutely crucial, because if you think about our first concept, that is the time value of money. So we have discounting in the net present value. Now, because we're using a discount rate that is based on the client's required return or the weighted average cost of capital, then that discount rate will basically ensure that an uncertain return is worth less than a certain return. Because the more risky the investment, the more that discount rate, or the higher that discount rate should have been. But that's been determined exogenously. The decision criteria is very, very simple. So if the net present value is higher than the price that you're going to pay, then you should buy that property. If it's lower than the price you're being asked to pay, it says sell. So I suppose what it should say is you don't buy the property. So it's a very, very simple decision criteria. It has got the time value of money in there, and it also adjusts for the uncertainty of the cash flow by changing the discount rate. Now, as I say, the textbooks will tell you to use the net present value. The property industry will quite regularly use an internal rate of return. Now, the difference between an internal rate of return and a net present value, well, there's not really particularly much difference. So what the internal rate of return does is it basically solves for the rate that will equate the net present value to zero. So it's basically solving for our discount rate. So that means that the decision rule is just subtly different. So now, if the IRR, or your discount rate stroke required return, is greater than your required return, then you'd buy. If it's less than your required return, then you would not buy. So hopefully what you can see there is that both of these metrics have got the time value of money. Both of them are adjusting for the uncertainty. So in many ways, they're going to give you a very, very similar answer. Why do we tend to use an IRR in real estate and not NPVs? That is a very, very interesting question. I think it's because people tend to think quite literally. So they think about the fact that they're going to buy this property. There's then going to be some cash flows over the next few years. They'll possibly do something to the property, some active management, and then they'll sell the property. And that lends itself very nicely to sort of an IRR, because an IRR, you've got your entry value, you've got your cash flow, then you've got your exit value, and you can solve for the return that you're going to get. So I think it feels more literal to people than doing a net present value. But essentially they are the same, and we shouldn't worry too much that the industry uses an IRR. However, there are sort of some more fundamental issues with using either of these decision metrics. Because although they take account of the time value of money and they also adjust for risk, what they don't take account of is how much cash is available to invest and what opportunities are available. So let's just think of a very simple example. Let's imagine we live in a wonderful world where we have £10 million to invest. We have two investments. One of those investments is for £1 million, and that's going to give us a 20% IRR. There's another investment available, which is for £10 million, which is only going to give us a 5% IRR. Now, obviously, the IRR is higher and the NPV is higher on the smaller investment. But what if that was the only investment that was available to you? Then quite clearly you'd be better off investing all of your money into the larger project, even though you're earning a slightly lower IRR, because you're obviously doing it using up all of your cash. So the problem with the concept of an IRR and an NPV is it basically assumes reinvestment. So if we go back to the money that we were putting in the bank and we were reinvesting and we were getting the interest every single year, your money's in the bank and it's reinvesting and it's compounding up. But of course, if we're calculating our interest rate, if you like, using this IRR, then you don't necessarily have all of that money. So what's happening to the rest of your money? I think I used 10 million and 1 million. So what's happening to the other 9 million? What return is that getting? So the problem is with the NPV and the IRR, it's assuming things that are, if you like, in isolation. So what can you do about that? Well, what you can do is you can reference some other metrics. So the two most popular are the equity multiple and the cash on cash. And the equity multiple is basically going to add up all of the cash that you're going to receive. So it's not going to take any account whatsoever of the time value of money. It's not going to risk adjust it at all. However, it is going to tell you, look, at the end of the day, how much money have you got in pounds? The cash on cash, relatively similar. Here you're basically going to be adding up what flows of money you've got every single year, and it's going to divide it by the amount of outlay that you've got. So I'm not going to go too much through today exactly how they're calculated, but the important thing to remember is that these two metrics don't take account of the time value of money. They don't risk adjust, but they do take account of the cash available and the opportunities available. So they are useful metrics. Now, having said I'm not going to run through some of the nuts and bolts, I thought we should just show what a analysis would look like. Now, there is quite a lot of information on this page, so I'll try and summarize it as much as possible. So it's what we call here a core plus investment. So basically, just by the fact that they've used this language, we know we're basically talking about an investment for an unlisted fund. And therefore, we know that the required return is going to be a core plus type return. And indeed, it tells us down here that the return required is 9.5%. So that's been told to us exogenously. We're then basically told the information on the property, the information on the leasing, and we're going to do a little bit of refurbishment. We're also told what the entry cap rate is and the exit cap rate is, which means we can do a very simple IRR analysis and NPV analysis. So we've got our rent coming in here. We've got a tenancy due to expire, so we've got a bit of vacancy. Gives us a net rent. We're then going to take off our irrecoverable costs to get down to what we call the net operating income. We're then going to take off how much it's going to cost us to pay for that property, and the capex is going to give us our unleveraged cash flow. We're then going to take out a loan. We're going to pay some interest. It's going to give us a net cash flow. Here's one of our first metrics then. We've got the cash on cash return. So here you can see here that we've got a return coming through, which is basically the cash flow that we've got left over our initial investment. You can see one of the downsides of the cash on cash return when we hit a vacancy, we then can't calculate that number. But it's a nice number, and frankly, if you've got leverage, then you're always interested in this number, because it basically gives you an indication of how close you are to not being able to pay the interest. Here's our frontline metrics though. So we have an IRR coming in at 8.88%. We have a net present value, which is negative. Now, as I said, the IRR and the NPV will nearly always give you the same answer. The IRR is less than 9.5%. So it's less than our required return. Therefore, we're not going to do this investment. The same story for the NPV. The NPV is negative because the discount rate that we used when we applied it to our cash flows and we added them all up, it gave us a negative number. What about our other metrics? Here's our equity multiple. So the equity multiples come out at 1.55, which means for every euro that's invested, the project's getting back 1.55 euros. However, it's not telling us anything about the discounted value of that or the uncertainty. Net profit, very, very similar. It's basically just telling us at the end of the day how much cash have we got compared to how much cash we put in. So you can see our frontline decision matrix there are going to make the decision for us, but it's useful to monitor the cash on cash return and also the equity multiple and the net profit. If we had to choose between 5 or 6 investments, say, then we'll be far more likely to start saying, well, okay, I'm interested in getting the maximum net profit, because that would be where we are rationing the amount of capital that we have available. So hopefully that's given you a simple run through where you can see the metrics and you can see how they're used to make the decision. Let's just think about what's happened though over the last sort of, how long has it been now? Feels longer, probably about 12 months. But what we wanted to show you here is what happened in recent times when the interest rate has gone up, because it's also a nice way of illustrating the impact on leverage. Now, what leverage basically does is it increases the risk, because it's going to make our return more volatile. So we're going to increase the risk of our cash flow. But what we're particularly interested in is whether the debt is actually going to be adding to our return, i.e. be accretive, or it's actually going to be lowering our return. So let's just think, very, very simple analysis here. We've got an acquisition, we've got our discount rate, we've got some growth, and we can basically apply an amount of debt. So here we've got 65%. So that basically means our debt is 65% of our acquisition price. And we've got our interest rate, which is basically the margin plus the base rate, the SONIA. What does that do to our numbers? So it basically takes a 5.8% IRR and it increases that to 10%. I'm not going to look at too much of the other numbers, just focus on these two. So the 5.8% has gone up to 10%. So I think you'd all agree that leverage there has increased our IRR. However, what we found by October 2022 is that our margin had gone up. So you can see base rates here. Sorry, our margin stayed the same, but our base rate has gone up. So SONIA has gone up. So you've obviously seen in the press that interest rates have gone up significantly, which means that the cost of our debt now has gone up to 375 basis points. Our unleveraged IRR is 5.8%. So I've not actually knocked our growth rate. I've just said it's going to be the same. But you can see our leveraged IRR has been reduced. However, the increase in base rates went further. So by October 2023, we were up to 4.2%. So now the impact on our cost of debt means that our leveraged IRR is actually below the unleveraged IRR. Now, there's lots of different ways to think about that. One thing you could say is, well, it doesn't make sense today to leverage up our investments. Or you could take a slightly different view, which is, well, actually, most investors are using debt. So they are now not going to want to spend as much money on the property in the direct property market as they would have in January 2022. So because the cost of debt has gone up, even though the unleveraged IRR has stayed the same, arguably the value of the property has actually gone down, because investors are not going to want to spend as much money, because the way to get your target IRR on the leverage basics back up to 10% is basically to pay less. So this is an argument that the value of property has gone down because the interest rate has gone up. And I'm sure any of you following the press would have noted that there's a huge number of questions at the moment about A, how far have values fallen, and B, how far are they likely to fall in future if interest rates stay high or even go even further. So these are very, very topical discussions that are going on at the moment. And it's all about the target return for investors and the cost of their debt. Now, there's another very important concept that I want to just touch on today. We do a lot more on the course, and that's the difference between implicit and explicit. So what I mean by implicit and explicit is to say, how many of the assumptions about uncertainty have you put in the cash flow, and how much of that uncertainty is therefore needed to be reflected in our discount rate? So let me take a very simple example. So in the cash flow we ran through, we had a lease expiry coming up. So the question is, have you accounted for the risk of that lease expiry explicitly, i.e., have you put it in the cash flow? Have you basically put in an expected vacancy period and associated costs? If you have, then you don't need to adjust your return. If you haven't made that adjustment in the cash flow, what it will mean is you have to make an adjustment to your required return or your discount rate. So you might think, well, that's very easy. Every time I've got a lease expiry, I can make an adjustment for that in the cash flow. I can put in a vacancy period. But what about more difficult things? What about when you have, for example, the risk of a tenant going into insolvency, going into default? So to adjust for a tenant default risk, what tends to happen is the cash flows are not adjusted, which means that the discount rate or the required return will need to be adjusted. The other things that we tend not to adjust for in the cash flow are things like volatility. So if we have a very volatile rental market, it tends not to be adjusted for in the cash flow, in which case we would need to adjust for that in the discount rate. And for those of you who are thinking, well, the only way you can adjust for the volatility of cash flows is to move towards Monte Carlo type analysis, you'd be absolutely correct. So that's what I'm referring to. So when we're doing a very flat cash flow analysis, which is quite often quite implicit, then we need to be adjusting our discount rate for those risks that we've not included. And the way I think about that is basically to think about a triangle. You can do this any direction you like. So say you've got a value, you think about, well, what cash flow assumptions have I made? What risks have I not put in the cash flow? I therefore have to put those in the discount rate. Or you can think about it another way. You're given a value, say from a valuer. You then want to know, well, what assumptions as the valuer made in the cash flow, because that's going to affect the discount rate that appears. So in the case of valuation, that discount rate would then be an all-risk yield, for those of you who are studying valuation. So that's what I'm referring to. So you get an all-risk yield because you've got virtually no assumptions in the cash flow. So this is the triangle that we think about: the value, cash flow assumptions, are they implicit or explicit, and therefore the associated discount rate. So hopefully that's given you an overview of the theory underpinning financial analysis, whether for an equity investor or for a debt investor. So what we ran through today was we've got to take into account the time value of money. We've got to take into account the uncertainty, and the way we do that is we take our required return, and that required return should be provided to you exogenously. So it should be outside of the system. So that could be the weighted average cost of capital or the required return from the style of the property. However, if we've got any risks that we've not accounted for into our analysis, then we have to make some adjustments to our discount rate. Excellent. So I don't know if we've got any questions, Sonia.
Not yet, Malcolm. Thank you very much. It was very, very good and very insightful. Now we have a bit of time for Q&A. So if you guys have any questions or you would like Malcolm to recap in any of the concepts here, just let us know. We have like 5 to 6 minutes for this. In the meantime, Malcolm, I got one question for you. The other one I think has been already answered. But this one, can IRR give you distorted decision making?
Yes, so this is one of the big issues with an IRR. Now, it tends not to be discussed in terms of commercial real estate. It tends to be discussed in terms of what I would call private equity. So the issue about private equity is that the financing is arranged so that the investments are drawing down capital from their investors, and then they are using finance, and this gives the cash flows a very unusual shape. Now, the result of that can be a very distorted IRR. So, for example, imagine you put up 100 million to invest, and the structure of the investor meant that 10 million was basically returned very early on. Now, why is that so distorting? Well, that's distorting because the IRR will give that 10 million a lot of weight. So when you do your IRR calculation, you'll find you get a very high IRR. But the key point to remember here is what the IRR will do is it will assume that you can get the same return constantly or compound that return. Now, if you're getting 10 million back in the first year, it looks like you've got 10%, or if you're getting it back in after the first few months, you might be getting 25, 30%. So the IRR is giving you this great big number, but actually, in reality, you're not going to be able to reinvest that money in practice. So you've been given that money back, but you're not able to reinvest it and get another 25% next year and the year after and the year after that. So that means the IRR can be very distorted if there's very early return of capital. And that's where you should do a check. So you do a check, you say, right, there's my IRR. But does my IRR give me a genuine compound rate? Think back to that very first graphic. We're interested in earning compound interest because compound interest is what generates your return. If it's distorted, you'll see that by looking at something like the return on equity. So you could get a very high IRR, but actually your return on equity is very low. Sorry, your equity multiple is very low. And that's a classic check. And you'll see this debate mostly within private equity, where people say, you've published these really, really high IRRs, but actually your investors are not seeing that compounded. It's not generating that much wealth to them. It's a genuine IRR, but it's not really a true measure of the compounding. So it's one of the distortions of the IRR metric. And frankly, it's quite cynically exploited in the private equity industry, and I'm sure some of you will go on and work in that industry and see that cynical exploitation yourself. But you'll also read the criticisms of that, because it looks like private equity is generating massive returns, but actually it's not, and that's where you go to the other metrics.